Hi everyone, I hope this video finds you well and above all that you are keeping yourselves as well as your family safer in such troubled situation. This video is about the fourth chapter. As you might know, our midterm will take place Saturday inshallah. So it will be profitable for you to have some reviews before the exam. For this video we will focus on two exercises in the fourth chapter that will cover two different topics. The first one, which is exercise number 7, I think, page 143. It's about the break-even point, survival revenues, while the next one, which is the 8th exercise, page 144, is about the cash flow income, the cash flow statement, sorry, as well as the cash build or the cash burn rates. So we will use Excel to solve these two exercises. So the good thing with Excel is that, as you will as we will see later, it will allow you to save a lot of time during the exams, and above all, it will make your calculation safer. So let's start and let's move to the exercise number 7. Page 143, exercise number 7. So as you can clearly see here, I will zoom in so I can make it clearer for you. So as you can clearly see here, the exercise number 7 deals about variable expenses and survival revenues break even. The Castillo Products company, described in the previous problem, had a very difficult operating year in 2009, resulting in a net loss of $65,000 on sales of $900,000 for 2009. In 2010, sales jumped at $1.5 million, and the net profit after taxes was earned. The firm's income statements are shown on the following page. So these are the income statements for the years 2009 and 2010. Now, the first task is to calculate each income statement item for 2009 as a percent of the 2009 sales level, and do the same things for 2010. Then determine which cost or expense items vary directly with sales for the 2-year period. So as I told you before, we will use Excel to solve this exercise. So first, all we have to do is just to rewrite the income statements on Excel. So I already did it, so to save time. So these are the income statements in dollars. Sorry, for 2009 and 2010. Now, what we are asked to do is to transform these income statements from dollars into percentage. So let's transform it into percentage. 2009 and 10. So the first row is for net sales. So we should transform these two numbers into percentage. Since we are asked to rewrite each item compared to the sales, so this is the baseline. So we should start by 100% for each of these 2 years. Now for the cost of goods sold, now we'll transform this number into percentage compared to the net sales, which means equal to the cost of goods sold of 2009 divided by the sales of 2009. So we see here that the cost of goods sold represents 60% of the sales of the year 2009. Then we do the same thing for the gross profit. So equal to the gross profit divided by the net sales, and so on. And we can do it item by item. But by doing so, we risk to lose time, right? So there is another technique that will allow us to save time. since every time you are using the same net sales, right? So this cell is fixed. So instead of typing B5 divided by B4, we have to, so B4 is the net sales, right? So we have to make this cell fixed and changeable. So in order to do so, we will add the $sign to the cell B4. By doing so, we are fixing this cell. Then click on enter. So we keep the same number, see? We are just fixing the B4. Now, we will put the cursor or the pointer at the corner of the cell, click on it, and then scroll down. It will automatically remake the same calculus using the same net sales. So for example, we can click on this cell, the marketing expenses, for example, see, is equal to B7, this one, B7, divided by B4. Now, the next cell, which is administrative expenses, equal to B8C divided by B4. So we are varying the cells across the items, see, but we are at the same time fixing the cell of sales. And we will do the same thing for 2010. So equal the cost of goods sold divided by the sales of 2010. Then we will fix this cell. Then we'll click on the corner of the cell and scroll down. We can also transform all these decimals into percentages. And you can add, see? So this is the first task. We have transformed the dollar income statement into percentage income statements. Now, once we have done this, let's move to the next task, which is determine which cost or expense items vary directly with sales for the 2-year period. So the answer is pretty pretty simple. In order to distinguish between the variable costs and the fixed cost, we use the cost per unit, right? So the variable costs have a fixed cost per unit, right? I repeat, the variable costs are fixed per unit, while the fixed cost per unit are variable. See? So for example, we see here that the cost of goods sold represents 60% for both the 2 years, 2009, 2010. It means that when we are dividing the cost of goods sold by the net sales, we have the same amount, even if the sales are varying. See? So per unit, the cost of goods sold are constant. This means that the cost of goods sold are among variable costs. Now, for example, so I will fill the cells of variable costs with the yellow color. Then the marketing here, see, for the marketing per unit, the marketing expenses per unit are also constant, which means that marketing expenses are also variable costs. So I will fill the cells also with the yellow color. Now for the general and administrative expenses, the amount, the global amount is fixed, while the percentage per unit becomes variable. This means that the general and administrative expenses are considered as fixed costs. So I will fill the cells of fixed cost, let's say with the green colors. Same thing for depreciation, see? So in terms of percentage, depreciation are varying, which means that depreciation has to be considered as fixed cost. interest, see, as percentages, sorry, the percentages of the interest are varying. This means that interest should be considered as also fixed cost. That's it. So the green color is for fixed cost, while the yellow column, a yellow color is for variable costs. Now the fixed costs are or can be divided into two parts. The virtual, let's say the virtual fixed costs, which are which are taken into account in accounting, like depreciation, but will not generate a real cash flow, right? And we have the cash fixed costs. These cash fixed costs mean that they are generating an out cash flow, right? So the fixed costs will be, see here, divided into cash fixed costs like general and administrative expenses, like also interest, see, and then we have what we can call virtual or fake expenses, a virtual fixed costs. And we mean by that the depreciation. See, so we have two types. The real one, or the cash one, the cash fixed cost, and the virtual fixed cost. Well, for the variable cost, see here, we have two types. We have the cost of goods sold, which represents 60% plus the marketing expenses, that represents 10%. Which means that overall the variable costs represent 70% of the sales. Variable cost represents 70% of sales. Now let's move to the task B. Use the information in part A to classify specific expense items as being either variable or fixed expenses. It's already done. Then estimate Castillo's EBIT break-even in terms of survival revenues if interest expenses had remained at the 2009 level in 2010. So let's start. So the task B. So we are asked to compute the survival revenues. So the survival revenues is the necessary or the required amount of sales that will allow to the firm to cover all its cash costs. All right. That's why we are using the EBIT, because the EBIT didn't take into account depreciation and the amortization, which are virtual or fake costs. So survival revenues. So this is equal to the cash fixed costs divided by 1 minus the variable cost revenues ratio, which is 70%. So we have, the first case, we are assuming that the interest expenses will remain a constant in 2010 compared to 2009. So this means that the survival revenues will be equal to, so we have the cash fixed costs are, as we can clearly see here, are general and administrative expenses plus the interest. So for 2009 we have $250,000 as general expenses, plus, now we are supposing that the interest will remain constant, right? So plus $45,000. So these are the cash fixed costs, and divided by 1 minus the variable costs revenue ratio, which is 70%, minus 70%. This means that if the interest expenses for 2010 were equal to $45,000, this means that the firm need to sell for $983,333 to cover all its cash expenses. Now let's move to the task C. So we'll redo the same thing, except that for this time we suppose that the interest expenses will be $60,000 instead of $45,000. Still, we have to keep the same formula for the survival revenues. So equal, we start by the cash flow or the cash fixed costs, which are general expenses plus the interest expenses, divided by minus 70%. Then we close the parentheses. So here is our formula for survival revenues. Then click on OK. See, when the interest expenses increase, this means that the firm has to sell more in order to cover its cash expenses. So if we apply this number, for example, to the sales of 2010, we should have an EBIT, which is earnings before depreciation, amortization, and taxes, equal to 0. Okay, guys, so this is all for the exercise number 7. So let's name the sheet, let's rename it exercise 7, see, and let's save our work. So we can use it afterwards for the exercise number 8. So let's call it chapter 4 exercises. And that's it. So I will save it. See you in a few seconds for the exercise number 8, inshallah.